It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So Hamilton Thorne, it's trading right now at a price of just over $1, has a market capitalization of just under $130 million. So what the company does is it's engaged in providing precision instruments, consumables, software, and services that reduce cost and increase productivity and results in the assisted reproductive technologies and developmental biology research markets. So this is a company whose customer base consists of fertility clinics, university research centers, animal breeding facilities, pharmaceutical companies, and biotechnology companies. So the company has fluctuated, the share price has fluctuated between 85 cents and $1.25 about over the last 12 months. It's down about 10% over the last year here. They did announce a acquisition in August. On August the 13th, the company acquired a company called Planer Ltd. They say that this acquisition significantly expands our product offerings in incubation, cryopreservation, and lab monitoring. And it also provides a direct sales and support platform for their entire portfolio in the United Kingdom. So the company's revenues have increased year over year. However, profitability is quite fluctuative. Just taking a look at the recent quarterly results, revenue in the second quarter of 2019 was $8 million. That's a 10% increase compared to the same period last year. Net income grew to just over $100,000 for the second quarter compared to a loss of $133,000 in the same period last year. And adjusted EBITDA was $1.6 million compared to $1.5 million last year. So basically flat. On a valuation basis, because there aren't a lot of earnings, the company is trading at over 40 times on a price to earnings basis. So that's quite expensive. On an enterprise value to EBITDA basis, 15 times. Fairly expensive as well, given the lack of profitability and the size of the company. It does have a strong balance sheet with $3.3 million in net cash, so that is a positive. But just as an overall assessment of the company, I like the space without knowing a lot about the fertility space. I like that space because I think that there's a trend there with people generally trying to have children older. But looking at the company financially, I don't really see a lot to invest in right now unless the company actually starts improving that profitability and offers the stock can be purchased at a reasonable valuation. I would say definitely at less than 20 times earnings. Until that time, we wouldn't be interested in the company as an investment.